If we stay only at adding 20,000 jobs or 30,000 jobs a month, guess what? Unemployment will go up. That's a fact. If unemployment continues to tick up, regular households are going to feel it big time. It's about to get worse, and I'm going to explain why. And by the way, hats off to you if you're ready, because most people really aren't ready. This past week, the Federal Reserve made a move that we hadn't seen in a long while, guys. Last week, the Fed cut the Fed funds rate by 25 basis points, or a quarter of a percentage point, bringing that Fed funds rate down to a range between 4% and 4.25%. Now, this is the first rate cut since last December. Quite a long time. Now, here's the details. The vote was 11-1 in the Federal Open Market Committee, right? That's the committee that votes on whether to raise the interest rates or not. The lone dissenter was the new Fed governor. He wanted an even bigger cut, a full 50 basis points, 0.5%. The Fed's official statement said basically growth has sort of moderated, job gains have slowed down, which we know, and we'll talk about unemployment that's ticked up. And so Fed Chair Jerome Powell called this a risk management cut. Translation, they're more worried about the job market now than they've been in quite a while. This is why it's about to get worse, and the Fed is giving us this very obvious signal, and why we should be thinking in emergency mode. The media's reaction to the Fed rate cut last week, okay, we saw some outlets that called it a cautious move by the Fed. Other outlets in the media said the Fed is way behind and late as usual. And some Fed officials even spoke up themselves. The head of the Minneapolis Fed said flat out 2 more rate cuts of 25 basis points each are likely by the end of the year. And then you got President Trump, right? And you know he weighed in on it. He blasted Powell, calling him too late Powell, as always. And he said this rate cut won't be enough. And he wants a larger rate cut to bring down mortgage rates and ease government debt costs. And Trump even tried to remove one of the governors, Lisa Cook, before the meeting because of alleged mortgage fraud that's not yet proven yet. But the courts blocked him from removing her. So she stayed in and actually voted on this rate cut. So the Fed is not just fighting inflation. They're also fighting political pressure as well. And some would say the Fed is participating in some of this politics as well. Now, how did Wall Street and the stock market react to the Fed cutting rates for the first time this year? At first, it was a mixed reaction, right? On the announcement day, the S&P 500 sort of dipped. But the very next day, which was last Thursday and into Friday, stocks went way up, and they stayed up at fresh record highs at the close of Friday. The NASDAQ jumped up, the S&P 500 jumped up, the Dow Jones jumped up, and even the Russell 2000, right? The small cap index fund, it went up by 2.5%, hitting its first record close in almost 4 years, guys. So the stock market, as expected, reacted favorably. Now, futures markets, they already had this Fed cut of 25 basis points baked in at a 95% probability. So we sort of all knew that this rate cut was coming, right? Now, right now, those markets, those futures markets are pricing in 2 more rate cuts this year in October and December. That means making money cheaper to borrow for individuals. But here's the kicker, cheaper to borrow for businesses too. And that's why the stock market usually reacts favorably when you see rates come down, because that means now those businesses can go borrow money at more favorable rates, right? But let's get into the heart of this whole thing and why I say it's about to get worse and we need to be in emergency mode, right? The job market, because this is the real story that everybody who just looks at the stock market is leaving out. The job data for August, guys, show the economy adding just 22,000 jobs. That is dramatically below what the expectations were, and it's way below the pace that's needed to keep unemployment steady. Now, speaking of unemployment rose last month to 4.3%. Still historically low. I get it, but the trend is upward. And we know that the 4.3% unemployment rate is not the whole picture. It's just a little smidgen that they want to show us. There's more to it. The details matter. About 25.7% of the unemployed right now are long-term unemployed people who've been out of work for 27 weeks or more. And that number's not going down. Manufacturing jobs are sliding downward. Construction jobs, and we know tech jobs, are falling fast. Job growth is now running below the break-even pace that's needed just to absorb the new workers who are entering the work economy, right? So here's the thing. If we stay only at adding 20,000 jobs or 30,000 jobs a month, guess what? Unemployment will go up. That's a fact. That's why the chair Jerome Powell said the downside risk to employment has gotten bigger because they're looking intently at this unemployment rate and this job market right now, right? So this is what's most troubling to me right now about the job market that we're looking at. Looking at the past 3 months, guys, the monthly non-farm payroll average that's being added is only 29,000, which is way below the 12-month average of 122,000 new jobs. Now, look, I've been doing these updates on YouTube for several years, guys, and I cannot remember new non-farm jobs being this low for this long. This is not normal. And let's keep it real here. When the job market weakens, it's not Wall Street or the stock market that feels it first. It's regular people like us, young workers, right? People with fewer skills and fewer credentials, the average American person. Regular people take the brunt of a rising unemployment or a weakened labor market more than anybody. That's why this Fed funds rate cut is not, in my opinion, about investors first. It's about trying to get ahead of the labor market slowdown. That's the big issue, right? So what happens from here? Let's talk moving forward. According to the Fed's own dot plot that they always use, most policymakers out here are expecting 2 more rate cuts this year of 25 basis points each time, right, before the end of the year. Now, that lines up with what the markets are pricing in. So that means we got to mark our calendars for the next Fed funds meeting that takes place in late October. And again, another one takes place in early December. Those are dates that we should be watching as investors and as consumers. Is this 25 basis point cut significant? Absolutely. It's very good, right? It marks the shift from a Fed that's holding steady. The Fed has kind of been white knuckling this thing for a long time, right? To finally a Fed that's starting to cut rates. But Fed Chair Jerome Powell made it very clear in his speech after the meetings that this isn't a sprint and that they're going data by data, like they always say, meeting by meeting, and inflation is still sticky. And again, guys, this is a data heavy Fed, right? It's not really a forward looking Fed. So for investors, here's how you should be thinking about it. In the short run, stocks may benefit. Ooh, everything's going to look good. Stock market going up. Fresh all-time highs, right? We like that. But that can be a smokescreen, okay? Listen to this stat. The stock market has hit 27 record highs this year already. The stock market hit 57 record highs last year. But in 2023, the stock market hit 0 record highs in all of 23. And in 2022, there was only 1 record high. So here's what I'm saying. The stock market right now looks like it's booming, but guess what? That can be smoke and mirrors. Also, as an investor, you need to be thinking about bond yields rising. Why? Because rising bond yields usually translates into higher interest rates on mortgages. So all of this is happening sort of at the same time, which is why the Fed said, look, let's lower rates and let's counteract the higher bond yields and hopefully make borrowing costs for mortgages, auto loans, credit cards, and business loans ease up just a little bit. Now, here's my suggestion to you. Stay diversified. Don't chase hype right now. Keep some cash. Play defense. You play an offense, but play some defense too. And get your job skills up. Learn some AI, keep your resume updated, get the certifications so you have more options in this job market that's changing. And for consumers, strengthen your emergency fund. Get your 3 to 6 months minimum of emergency cash put to the side somewhere, right? And then pay off debt, right? Work on your network of people and try to recession-proof yourself during this time. And if you can, build some additional streams of income too. Multiple streams of income keep you safe when the job market slows down. So here's the big takeaway, guys. In my opinion, this is not just a 25 basis point cut. It's about what that cut signals to the rest of us, right? The Fed is basically saying that the job market is flashing yellow. Caution. Inflation is still high, higher than we want. But employment risk is starting to sort of dominate the conversation at the Fed and dominate the decision making at the Fed when it comes to these Fed funds rate. If unemployment continues to tick up, regular households are going to feel it big time. This move that the Fed made was trying to get ahead of that. Or maybe some people are right. The Fed is just trying to play catch up, right? But at the end of the day, it's the job market that matters the most for you and me. So my plea to you is protect yourself. Stay ready. Get in emergency mode now before the emergency, right? Guys, do yourself a favor. Hit that VIP early access link in the description box below and lock in a huge discount on my new course, The 4 Steps to Maximize Your Money, when it goes live on October 1st. Now, if you got value from this update, smash the like button for me. Share this video with someone you know, and don't forget to drop a comment below. Remember, the best person who's going to take care of that old you is the young you. Take care of people, but also take good care of you, because you're people too. Until the next video, peace.